Unless I'm the one that's doing the absorption, I'm not fading that candle at any stage. What I'm going to do is I'm going to start buying it for a momentum trade. So as soon as I identify where the volume is, I'll put my bid in at that price and I'll take it as a Momo trade. If alternatively I see a candle that looks like this, and the volume's coming into that is this level here, the volume's coming into this level here, I'll fade that candle. I'll start buying into that for obvious reasons, yeah? I don't have to wait because the volume is right through that bar in most cases. So when I see an absorption print, when I see a high volume absorption print and it's a very, very small candle, just wait for the Momo. So this becomes a Momo buy trade here. And this becomes a fade buy trade here. It's the same volume, but because of the shape of the candles, you've got a whole different storyline evolving, haven't you? Because think about it. These sellers are getting trapped. These sellers don't necessarily, none of them are necessarily getting trapped. Instead, in fact, the sellers, because of the size of that candle, they'll book. And that'll put a bid into the bottom of the candle. That's why the big candles reverse and the small candles kind of stick. Yeah? Big difference. All right, that's obviously the Fed's trade is done and dusted, guys. Fed's trade is done and dusted. So let's take a look at walk through the order flow on that trade. Long equities for me at the moment, guys. Long equities. I got a profit and a scratch on my my bonds, so I'm off the bond. I'm long equities just now, off the bond at the moment. So let's take a look for me at the Fed auction. This is a 30-second chart coming into the Fed. When I say the Fed auction, basically they go into the markets, not the futures markets, and they buy coupons. They buy coupons. Okay, so when I see 3:10, I start watching what happens after that red line. Okay, so after that red line, the first thing you see is an awful lot of book selling shows up. Okay, so we know that that's not what we're expecting. Why would a lot of book selling show up in the futures markets if the Fed's going to start buying some coupons, right? So you've obviously got to see that. Once that shows up, if you were buying it preemptively, you just close off your buys and you scurry quickly into a quick short trade. Now, it's never really going to go down by much because the Fed is buying it, of course. So you don't have to buy this phase. What you're waiting for, of course, is what? Well, what you're waiting for, of course, at this stage now is to see this phase. You're waiting for that phase to show up. When that phase shows up, that's now in line with the fact that the Fed has 20 odd minutes, New York Fed has 20 minutes when they can bid into this underlying bond market, right? So they've got 20 minutes. They don't have to buy on the first candle. They can try and pick and choose their positioning to buy into these trades, right? So they've got 20 minutes. So when the book changes here, then I know that now's the time to start bidding into the bond. I want to buy that phase right there. Buy that phase, correct? So now that we see the opportunity to buy into the lows, there's your buy trade there, there's your buy trade there. You don't have to bother with the sell phase because it's only buying at this stage. You want to try and find the buys, but obviously we get a very good buy rip to that trade, which is really, really nice. We get a good trade out of that. As we move up into the top edge, of course, at 1:30, start that one again. At 3:30, that's basically it. The buying in the market comes to an end, and we start watching to see the first signs of any selling coming in, which happens obviously here. And obviously for me personally, that's either a quick short trade behind that selling. Now that the Fed's demands disappear off the market, we can take a quick short into that, depending upon whether equities are catching a bid. If equities are catching a bid, then obviously what happens? If equities catch a bid, then it's going to be an easier short at that stage. And that's what we did. We just sold into that price at that point, and we managed to get a quick scalp profit. The buyer spike came back in, and we got picked off on that little trade. But I'm still long equities, and doing very well on the Momo buy off the bottom edges at the moment. So that's a nice trade for us. A nice trade. Does that make sense to everybody? Make sense to everybody? Anyone? I don't know if anybody's even bothered trading this. I assume so, because there's a few guys that making mention that they were bidding the bond, and making some monies out of it. All good? All good in the hood, guys. All good in the hood. So very nice order flow. Very nice order flow attached to that little storyline. If you like it, then you can trade these each depending upon the size and the volumes that come in at this time of the day. A very, very nice ability. A very nice ability to make some quick cash on those types of trades, guys. Beautiful. Lovely, delightful, deliriously sensational. Next up, guys, 4 o'clock for the oil inventories. Woo-woo! Oil inventories, guys, 4 o'clock. Bottom edge equities, thank you very much, if you don't mind. Bottom edge equities, take a look and see what the volatility guys make of this. Well, you can see it quite clearly from the volatility perspective. Volatilities aren't even any higher than they were pre-market, guys. So I am a buyer of bottom edges. Buyer of bottom edges. Buyer of bottom edges. So there you go, bottom edge is this orange line inverted. So you can see that buying into this orange line inverted makes a lot of sense. So I've been picking off some buys into these areas here. I've been picking those buys off, and we've always had a very reasonable rotation. A little bit more difficult because we're now stuck below the 39 handle, of course, which means there's going to be some supply coming in above us. So we need to, once we're below this level, we want to make sure we've got enough rotation to get into the buy and then get it away from there. So we can obviously look at that from the puts calls perspective when we get into classroom just after 4 o'clock, after the oil inventory's out the way. We can start looking at the positioning of the gammas in real time so that we can see where the gammas did come in for that trade. Well, it's all about the context, Sam, isn't it? Because the context of the belly to the front end and the back end becomes very, very important to us. You know, it always starts 2s, 5s to 5s, 10s. If the 5s, 10s has got room, it makes the trade a lot easier. Sorry, if the 2s, 5s has got room to the 5s, 10s, it makes the trade a lot easier. If the 5s, 10s has got room to the 10s, 30s, it makes it 10 times easier to get a trade on. But that's only assuming, of course, that we're not going to be buying the 10s, 30s like we were yesterday into the close for a steepener, because obviously that's going to close the door on all bond trading. It's a curve trade at that stage. So if I'm going to be buying a very cheap 10s, 30s, then obviously I'm buying that because I think oil prices are going to stay high at that stage. Then obviously that situation there is going to be a sell on bonds, because you're going to be seeing a parallel shift north because of high oil prices or high equity prices. So it all depends basically on the relationship of those elements plus the likes of the absolutes and the break-even narrative behind the equities and oil. So, you know, just taking one in isolation is going to be tough. If you can't see it clearly, you just don't trade it. That's usually the motto of any bond curve trades. If it's confusing or conflicted, you just trade oil, you know. Just trade oil, trade something else, and just wait for it to become a little bit less confusing.